Markets have had a solid run so far this year, so what possible catalysts are there to drive it even higher? Joining us now to discuss, Jing Roy, VP Director and Portfolio Manager for Asset Allocation at TD Asset Management. Jing, great to have you back on the program.
Thank you for having me.
So this is sort of a nice, we're not quite halfway through the year yet, but we are moving into the nicer weather. People start thinking about the year we've had so far and what could happen going forward. Well, what are the key things you're watching?
Well, 2024 is really a year of rate cuts and election. So let's take a look at rate cuts. The expectation for rate cut really reached a fever pitch in January. And since then, the rate cut expectation has been retro back by two to four rate cuts because of the sticky service inflation and more resilient growth. But in the developed market, the Swiss National Bank and Sweden's Riksbank actually fired the first salvo in the rate cut cycle. So this year, investors are actually expecting first rate cut this summer from Bank of England, ECB, and Bank of Canada. And that's going to be followed by the Fed in November. Now, perhaps equally as important as the timing of the rate cut, it's the depth of the rate cut cycle. So currently, the rate cut cycle is a bit shallower than usual, about 7 quarter cuts in total. And that's to account for the higher neutral rate, which has gone up to clear the market of higher investment demand versus the pool of saving we have. So in terms of rate cut, it will have an impact on regional asset performance, as well as currency and sector rotation. Now, moving on to election, we have EU parliamentary election this June and very important US presidential election in November and UK general election by next January. So the general sense of those elections is that we probably have swung too far towards the economic integration. So we need to balance back into sovereignty in terms of Europe. Because they don't want to be held hostage for the economic interdependency. And for US, it's more swung towards democracy in the sense that for the people left behind by the globalization, their needs need to be met in a better way.
I find it interesting when you talk about the fact that when I think about rate cuts and I think about election, of course, my mind immediately jumped to America, because they dominate the headlines. You pointed out there are other things happening in the world and a divergence. When you talked about the central banks, including ours, that are expecting, one are they expected to cut, one is the Fed expected to cut. A bit of exceptional performance out of the US. So we are fully expecting then a divergence between what the Fed's going to get up to and what other central banks, including ours, are going to get up to this year?
Well, there are a lot of opportunities because of central bank divergence in policy. So let's take a look at regional asset performance. We tend to look at that in local currency terms. When the regional central banks start to cut rate, it's supportive of the liquidity in the domestic market, especially in small open economies. So the local currency return for the assets will actually improve. But at the same time, because you're cutting rates, that will put a downward pressure on the foreign currency. Especially mindful, we have to be especially mindful as a global investor in Canada, because you don't want local currency return that's strong, but being the return be eaten away by the depreciation in foreign currency. So in certain instances, it actually makes sense to hedge the currency bet. It doesn't mean that in the U.S., because of the economic exceptionalism and the more hawkish central bank, it doesn't mean the asset return will not be good in the U.S. because you have a strong U.S. dollar to supplement your asset return. So in a rate cut scenario, we expect higher fixed income price, bond price, equity prices because liquidity, and especially within equity, companies are more vulnerable with a balance sheet, higher leverage, and with more pressing need to access the capital market actually will do better because of the more liquidity injected into the system.
When you talked about the election as well, and I'm going to focus on the U.S. election, even though you mentioned obviously there's other votes happening in the world, we get a lot of questions from viewers, and you get the sense that they're trying to figure out what should I do ahead of the election. But it's not very easy, right? Because we do not know the outcome of the election.
A trick question. On the one hand, if you're an investor with very long-term investment horizon, you'll probably be better off sticking with the old adage that, timing the market beats timing the market, especially when the market does go up 80% of the time and actually in concentrated bursts. But on the other hand, for investors who have an information edge and sophisticated investment tools at their disposal, they definitely should take advantage of the event and position accordingly in a risk-conscious way. So here, let's take a look at the US election. On the polls, it's right now a toss-up between a Biden or a Trump presidency. But there are two most likely outcomes. One is where Biden takes the presidency, but the Congress remains split. And in that scenario, it'll be fairly status quo, so not very many opportunities there. But the other outcome is a Republican sweep. In that scenario, you have impetus for pretty drastic change in policy direction. So let's take a look. In that scenario, inflation probably will go up higher because the Trump administration would advocate for immigration curbs and also universal tariff. That will increase the cost of input for a lot of companies. Especially for China, the tariff might go up to 60% because if the most favorable nation status is revoked. And second, the growth in the U.S. might be higher because, the 2017 tax cut can be extended and the deregulation obviously will be supportive of growth. And also you're seeing the price of money will remain higher because you have reshoring, investment demand from reshoring pitched against, the dwindling pool of saving because that pool of saving usually comes in a form of current account surplus from exporters. Because of the punitive tariff, that pool of saving will go down. So in order to position for that, we're seeing the volatility in the US dollar market will increase. The outcome becomes very wide in the Trump administration. Tariffs would actually, and higher growth will be supportive of US dollar. But on the other hand, if the central bank independence is compromised, or in a more extreme case, Plaza Accord 2.0, then the US dollar can depreciate. So in a macro arena where macro investors tend to put leverage bets through the derivative market, we're seeing the positioning currently is fairly light. If you look at the volatility term structure, there's a little kink around the election, but that speaks to the fact that there's still opportunities for us to position. And if you look at the broader equity market, the conclusion is less clear-cut because the policies work on the micro level and there's winners and losers. For example, for immigration curbs, the companies are labor intensive will be hurt. And on the other hand, for tariffs, manufacturing companies lower on the supply chain will actually benefit because they face import competition. But those on the higher up on the supply chain will hurt because they rely on imports. So it's not very clear who are the winners and losers if you just look at the index level.